If you are thinking about buying LEAP options and want to do it the safe way, this video will give you the main points that you need to know. Let's dive right into what LEAPs are, starting first with the acronym LEAPS, Long-Term Equity Anticipation Securities. So what a LEAP option is, and in this case, we're going to be looking at a call option specifically. It is a call option with an expiration date that is long into the future, most of the time being over a year out until expiration. Now, this is a vast difference compared to most option trading strategies that are out there. Most of the strategies that you're going to see traders use are a 1 day, 1 week, 1 month, maybe 3-month max window for the expiration date on their options contracts. LEAPs go way beyond that to the realm of 365 days, 400 days, 500, even 700 days out in the future. So why do people use these options instead of just going short term? Well, it's because you can control 100 shares of stock for a long, long time, very cheaply compared to buying it outright. And you're going to see in a second an example walking you through an actual LEAP contract that we're going to go through and buy and show you the difference between buying a LEAP option compared to buying the stock outright. So here we are inside Interactive Broker showing you Apple in the options chain with an expiration date around 42 days. And you can see that that's a pretty normal expiration date you might see on other trading platforms. Let's push this out into LEAP territory and get into what a trade looks like. We'll scroll across the top there, and you can see this goes all the way out to 805 days away. That is mega into the future. Let's go to the 365-day area for this example. And there we're going to click on actually 413, just past the full year mark, December 20th, 2024. So here we are with our expiration date over a year into the future. And now we want to focus on the call side and look at the delta and the strike prices here. So let's move the delta column over. And why this is so important to focus on the delta is because the delta that you choose is going to give you the amount of returns that you get. So if you buy stocks straight up, let's say you bought 100 shares of Apple on the open market and the stock price went up by $1. That's going to give you, let's do the math right there, real quick, $100 in profit, right? If you picked a 175 strike for your call option and purchased this for $23.95, this 64.8 becomes very important. What this is telling you is that for every dollar that the stock price goes up, you are entitled to $64.80. So not the full pop 100, you're not quite there. You're missing out on roughly $36 of profit. That's generally not a good setup when we're doing a LEAP option. We want to maximize this and try to move in tandem with a dollar movement up means $1 for our options contract to go up in value. So what we want to focus on then is focusing on stocks that are further into the money again, ITM into the money. And anything that would be below this 170 area going up this way, the further we go up here, the further up on this direction, the further we go into the money. We want to stay away from the stocks down here on the bottom part. Anything over here that is out of the money, that is going down the wrong way, that is not what we want to focus on for this exercise when we're buying LEAP options. So we're going to be good, responsible traders and just move those strike prices down so we have the deltas that are increasing. And we can move this up so that the delta is almost right at that $1 mark, which means every dollar the stock price goes up, the options value that we buy for this LEAP contract will go up in tandem. We don't have to do that, but we can if we want to. What we want to do is look at these strike prices and delta and say, hey, I want to capture as much movement in the stock price as possible, but I don't want to pay more than I need to for it. So we look at the delta and let's target an area around 90. That's kind of my sweet spot when I'm doing this and a general rule of thumb. We've got 90 right there. Let's go over and look at the 130 strike and see how much that's going to cost us to enter this trade. So seeing this whole setup right here, this LEAP option, this would cost us somewhere in the middle between $55.20 and $57.60. Let's say it's around $56 even for kicks and giggles. 56 right there. We multiply that by 100 and it gets us to our grand old total right there of $5,600 to buy this LEAP option on Apple, meaning we can control Apple stock for $5,600 versus buying 100 shares at the current market price, if you just take that 176 in there and put it there, right, that's going to make it a $17,000 stock price to purchase 100 shares. So we're going to save roughly 12K by doing it through a leap option. We get almost the same amount of return, remember, because our delta is so high. So the main advantage to this strategy is that when the stock price of Apple goes up and you own the shares at $17,000 and get 100% of the movement. If the stock price goes up by $1, you get the full pop, right? That's good. But would you rather spend $5,600 and get a 90% pop? So for every dollar that this goes up by 1, you're capturing 90 cents. So you're still making a whole bunch of profit on this trade, and you're paying considerably less to get into the trade at the beginning. That's why people use leap options, because it is a low barrier of entry compared to buying the shares outright. So when would the best time be to buy a leap option in this scenario? Basically, when the market bottoms out, because you have the most potential upside. If you do that and focus on your 90 delta there and capture a good chunk of the gains for a much lower entry price, you are setting yourself up for a lot of success utilizing this strategy. And if this seems overwhelming at all and you're thinking, I don't even know what a call option is, I was right there with you when I started trading myself. To master the basics of stock options in 2 days or less, check out my Options Academy virtual course linked right there. Now, most people think that buying leap options that far out in advance is almost a foolproof strategy for making money. However, people get into big trouble doing that and thinking that way, because sometimes the market goes sideways for an extended period of time, or the stock that you choose goes sideways for a long, long time, meaning the stock price never goes up, and eventually that option that you purchased does hit that expiration date without the stock making any meaningful gains. You result in a loss of the position, you lose your funds, and that is one of the drawbacks when you compare it to buying stocks outright. When you purchase the stock itself, you have an infinite amount of time to wait to sell and hopefully make more money. With the call option, it is a long-dated expiration with the leap, but there still is an expiration date that is looming. If the market doesn't move, you have to understand that you may have to exercise this option or close your position at a loss before the expiration date. That's unlikely to happen, and especially if you can combine your technical analysis and pick that market bottom for when you go and buy your call option leap. However, when you don't have the shares in your account, you also don't get the benefits of potential dividends if the stock pays them, and there's tax incentives to owning the shares versus owning a position like a leap option as an alternative. And I would feel bad not also letting you know that there is an opportunity cost here. If you are going to hold a leap option long term, you're committing to holding the position for a significant amount of time. That capital that you use to buy that option is now deployed with the game plan that you're going to be in that trade for a long while. Other opportunities may pass you by if you have the funds dedicated to this position. Just understand that if you're putting a large chunk of money, not as large as buying the shares outright, but a large enough chunk to take on this position and buy that leap contract. So now I'm curious, what would you rather do? Now that you've seen it explained, would you rather buy 100 shares of stock outright or buy a leap call option contract well out into the future? Leave a comment and let me know. And to learn how to buy call options with shorter expiration dates and really lean into a bull trend that is emerging, check this out.